Hello everyone. We are going to talk today about the recent messages coming from the newly appointed Trump administration, the Brexit strategy presented by Theresa May, and implications all over the world. Let's talk first about Trump and his program. Very simple. First, tax reductions. Tax reductions are going to be a key driver of an improvement in the economy. It's a very relevant factor to decide whether these estimates of growth in GDP are going to be strengthened with more consumption and with better investment. Also, repatriation of assets outside of the US, an extremely important part of the strategy as the Trump administration is looking to bring up to $1.2 trillion into the US. This is a key part of the strategy: strengthen the US economy, bring more investment, and be stronger in terms of consumption. There are some questions, definitely some questions about the strategy relative to other markets. Very aggressive strategy about renegotiating trade deals. Trade deals that are obviously going to continue, but in a different way. So we have to be extremely cautious about this and pay quite a bit of attention, especially to China. China has the largest trade surplus with the United States in the world, and China needs to probably renegotiate trade deals in a way in which it becomes more balanced, in which it's not just the Chinese exporting tremendous amounts of goods and services to the US, but a little bit more balanced. Let's talk about the UK Brexit. Brexit is actually becoming more of an uncertainty, but on the same side, it is very much about protecting the UK business and the UK consumer, and it's about improving access to capital by reducing taxes. So one of the key things that we're seeing is this tax reduction coming from the US and from the UK is at odds with the European Union that does not want to reduce taxes and definitely is aiming at protecting its model. So this can bring a little bit of challenges and uncertainties to the market. We have talked about inflation before. Inflation expectations are rising. Let's keep an eye on this, because this can also make that investing in developed countries becomes more challenging as interest rates start to rise. So let's pay attention to this as well. In general, what I would advise is to be cautiously optimistic in the markets. Earnings season, it's looking not as bad as many feared. Inflation expectations are more prudent than some others were expecting, and at the same time the general consensus is aiming more towards a level of growth that is on one side reasonably attractive, but also subdued, not very high growth for this year. So these uncertainties about global growth will come predominantly from the impact on global trade of the renegotiation of some of these trade deals. Let's pay attention to this. Let's pay attention, therefore, by being more invested in assets, in equities, where we see opportunities in companies that are less exposed to the cycle, that have a stronger balance sheet and a better dividend yield, and at the same time are more protected towards these challenges that appear in the environment of trade, which I think is, let's say it very clearly, the biggest question mark on all of the estimates globally, which is, are these changes in trade deals going to further impact global trade and make it more difficult for the world to grow as expected? So pay attention, because the outcome is not that negative so far, and we need to be prudently optimistic. Thank you very much.